This is Professor Campbell with a summary of the analytics part. So this is 22 different formulas and definitions to recall and understand. So this is a lot of calculations, a lot of practice. You must do these over and over again, and you'll see. And this comes from, the analytics comes from the blueprint. So in the blueprint, section F has a few lines there. So we've got 5 different applications to learn, a little bit of recall and understanding, which is what you need in order to get your skill. And I'll show you the categories and the different margins. And all of this information came from the AICPA. So the definition of each one of these is in the AICPA's website, and you can access that. So results are expressed as either the number of times or the number of turns an inventory makes, the number of days, days payable, days receivable, days sales. So it can be expressed as a number, or it can be expressed as a percentage, a ratio, a return is expressed in percentages. Margins are expressed in percentages. So make sure that as you're calculating it, once you get the number, say it to yourself, 1.76 times, or the ratio is 76%. So be sure to identify your returns are 8.6, so you know the range at which these percentages should be in the number of times. Okay, so as you're practicing in your review and things like that, always say out loud the number of times, the number of turns, the percentages, use the entire metric. So we have a couple of specified types of analysis from the blueprint. Profitability. Profitability ratios are gross margin, profit margin, return on assets, return on equity, and return on sales. So those are our profitability ratios. Our liquidity ratios are our current and quick ratio, our accounts receivable turn, our inventory turn, our days payable outstanding. And be sure to get the most recent definition of days of payable outstanding from the AICPA website, because you will also be asked for a cash conversion cycle. This is something that's not really in textbooks very often, but it is on the list for a cash conversion cycle. And of course, asset turnover. Solvency ratios, we have the debt to equity, the total debt ratio, the times interest earned, which is always a very interesting one to try to calculate, and the equity multiplier. Bing, 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 equity multiplier. What is that? It is actually something that we see in the textbook upside down. We normally see the equity ratio. The definition that the AICPA put out was equity multiplier, which is the actual reverse of what we see in the textbooks. So pay close attention to that ratio. Performance ratios like EBITDA, price earnings, dividend payouts, asset turnovers, these are all in their definitions. We should know what the appropriate meanings of these ratios and these performance metrics are for a specific type of analysis. Now, at the very bottom, it says calculate the variances between budget and actual. This is not the cost accounting where you're looking at the differences between standard and cost and calculating these variances and things like that. That's in FAR. Okay, this is FAR. So FAR, you're just looking at vertical analysis, horizontal analysis, and some kind of trend that you might see between the budget and actual. Okay, this is a copy of the AICPA website's 2026 updated analytical formulas. They've kind of put it in this horizontal which is like nobody uses that really. We use the um the a more visual framework for that, so I'll go over those with you. But these are the definitions of how each one is calculated. If you have analytics that you have gotten from other websites, other textbooks, other places, it might not be exactly the same as what the AICPA has. So narrow your focus into the AICPA analytic definitions, exactly how they calculate things. And I'll tell you, the days sales outstanding and things like that, and days of accounts receivable and things like that, they are a little bit different than some of the textbooks. You get the same answer, different way of approaching it. Use the same way that the answer is going to be created from these formulas. And once again, you got about 22 of them to work through. So make sure that you use this as a checklist, that you've identified each one of these ratios, you found problems, you looked at financial statements. One of the things that you can do is follow any company. Name a company that's public, say Google Nike 10K, and you'll get Nike's 10K. Print off the balance sheet and the income statement. That's all you'll need. Print that off and then do these ratios from a real company. So take a company like Macy's, who, as in the news, has been closing a few of the stores, unfortunately. Take their financial statement, the balance sheet and the income statement. You only need those pages, and calculate the ratios for a company that has different trends in terms of responding to the online marketing and things like that. Or take a company like that's growing very fast and see how their ratios work. Look at different industries. Look at a company that does food. How fast does their inventory turnover versus a furniture company? How fast does their inventory turnover? Just take a look and see reasonably what kind of ratios do you have from different industries, and the data is available everywhere. Okay, and if you want to check your answers, you've got ChatGPT, you've got Claude, you got anybody that you can ask, what's the current ratio? What's the quick ratio of Nike? Boom, you'll get it out of your artificial intelligence. So don't worry about getting to the answers, making sure that you're reading the financial statement correctly and gathering the proper numbers and calculating the averages when they need an average and things like that. And that's what you'll practice on. So practicing on authentic real companies will also give you an idea of how the ratios are interpreted and how they work with things. All right, this has been Professor Campbell summarizing analytics for you.